Scott's first question came in. He had a put for AZN. Stock dropped, but the premium did not move as I expected. What boxes and numbers should I enter? Well, first off, let's take a look at AZN. Of course, talking about AstraZeneca. And when I started looking into this, okay, see it's at 68.97. It's up 102 today. Let's take a look at the stock chart. And there were some big declines here, some declining premiums here, and then the stock started to swing back up in price. Now, depending on the entry, and I asked Scott for clarification on this, but I did not see his email. I didn't know what time he entered the trade. I don't know what expiration the put was, and I don't know what strike. Now, it's possible he could have entered a trade here, which he should have had really good profits at some point, any point, even if he chose a 1 week out or a 2 week out series that is getting close to expiration, even as all time values decaying. He could have entered the position here and seen the stock drop from 66 to 63. Okay, so maybe not as much of a movement. It's only 3 points. So depending on, again, on which strike you had, at the money, in the money, out of the money at the time that you wrote it, what would the gain or loss be? And then, of course, it started to recover. So even if I had, let's do it this way. Possibly if I had bought the call here around, if I had bought the put here around this time and I saw profits here, but then AstraZeneca started to recover here with 10 to 15 days, depending on the expiration that's available, I might just be at a break even at this point, even though it's down $1 or so from when I got into the position. So timing is key. The rate of decay is key. The expiration date and the strike price. See, if I had just bought a cheap out of the money 62 put and the stock fell, yeah, I might have seen a 30-cent profit on a 40-cent purchase or a 40-cent profit, maybe 100% return. But at this point, the option is probably back to 20 cents and I'm at a loss. You know, if I'm this deep out of the money or something even lower, say the 60 strike. If I'm at the 66, I would have seen some good movement down perhaps. But if I bought it when it was right at the money, then I would have bought it at the peak of the ATM bell curve and paid the most time value. And again, depending on the expiration, that's going to cause a problem as I'm getting closer and closer to it. Okay, so that's just some ideas. We're going to take a deeper look into that as well. Now, that's what we know the stock chart did. When was it bought? How big was the decline? And what was going on at the time? So what we're looking at with this decline here, that's going around the 20th or so. Yeah, starting around the 20th of December. I'm sorry, 20th of January into 25th, 26th, 27th. And then the stock starts to recover around the 1st of February, 2nd of February, and so forth. So was there anything going on in this time frame? Well, I see the next earnings are coming up on 4/27, which leads me to believe the most recent earnings came out on 1/27 or close to it, right as the stock was falling down in those prices. What does that tell me? Well, it tells me that if that was the position was on during the time frame around earnings, depending on when you got into the position, you might have been at the height of implied volatility for that particular option. And after the earnings event happens, the implied volatility is going to fall. And that's going to affect the time value. You're not going to see as much movement as you expected with Delta because the implied volatility collapses, or you see an IV crush in that case. The delta that you started off with and the expected movement of what you saw in the profit and loss chart is going to change dramatically. That's just what happens. And that's why it's hard to sometimes just buy calls or buy puts or even see profits with a long straddle or a long strangle as an earnings play, because you have to factor in that, hey, even if I get a 3 or 4% movement on this position, a 5% movement, if my implied volatility drops from 0.45 down to 0.25, that's going to negate possibly any intrinsic gain for the amount of extrinsic, that I had to pay into the position. Now, real quick, Scott did comment to me that he bought the April 65 put. So let's go ahead and take a look. April 21st, 65 strike put, currently at 113. Now, on Power Options, since this option is still available, I'm going to go to Research, and I'm going to go to Put Research. And the reason why I'm going to the Put Research tool here for our 65 put is because it's going to show me a graph of the option price over time compared to implied volatility, and compared to the underlying stock price. Okay, so again, I don't know what time frame you got into the position, Scott, but going back into that December period, we can see the implied volatility was up around 0.29 or so, maybe as high as 0.30, but that's all the way back to June. I don't think that's what you did here. I think you were closer in time, somewhere around January, somewhere around December. But even here, let's take this implied volatility, 0.285 or so. That seems to be the average. And then right around here, 122, 123, we see the implied volatility drop a little bit, and then it really just tails off. Now, is that a big move from, say, 0.285 IV down? At the lowest, it was 0.24. We're going to call it at 0.25. So it's only 0.03, right? That shouldn't be too much of a big effect. Well, let's take a look at what we'd expect today with these numbers if the stock dropped 2 or 3 points. But let's also take a look here from, say, 12.12 or say 1.8. Let's just use 1.8 when it was around that implied volatility of 0.285. And let's change our view here on the research tool. Instead of against implied volatility, let's look at it against the stock price. Okay, so here, back in October, let's just go to 1.8, shorten this up using the little scrubber down below. There we go. And we see here that this is where a big tail off on the option, bought around this time was around $1.50. Went up as high as 3, went up as high as 3.50. Now, if you bought here at 2.50 and the stock moved up to this price here, you had a 3.50 profit, a little bit less than 50%, $1 off of a 2.50 price. You did have a profit. And based on the delta, that's what you'd expect. At the time, the stock was at 66.50 or so. So you're slightly at the money or at the money, which means you also are buying into the peak of the ATM bell curve. That's a terrible ATM bell curve. I apologize. So, and then of course we know the earnings were around this point. And the stock sort of reflected that, and the put went up, and now the stock's starting to recover, and of course, and the put's declining. But the same thing is happening here, that the implied volatility was declining, so that's also taking out the extrinsic value. And again, if you bought in the 66 put when the stock was trading around these prices here, that means you're buying into the peak of the at-the-money bell curve, the highest time value at the time, with an implied volatility of around 0.285. Now, expected change. How can we evaluate this? Let's go back to the AZN option chain. We're going to take today's numbers, 68.97. Well, let's use that 67.50 strike, currently around that implied volatility I mentioned of 0.25. It's at 0.2429. We'll keep that. But let's go ahead and go to the, I can't go there from here. I apologize. Let's go to the custom spread tool and buy an April 67.5 strike put. Let's just call it $1.95. So again, AZN. I want the April 67.50 put. Buy one at 1.95. One thing, thank you, that I needed to mention here, and I just got away from it, didn't I? Let me go back to the chain real quick. Oh, no, I have it right here. I'm sorry, I have it right here. Somewhere. There it is. Expected delta of this position is negative 0.25. Now, this is this is yours. This is out of the money now. The delta's down to 0.025 now that it's out of the money. Let me go back to the chain. I apologize, folks. Go to the puts for April. Okay. The delta here is 0.377. So maybe the better example is that 70. It's closer to at the money at 315 or so, but still the same implied volatility. We'll stick with the 67.50 though. We're there. Let's use it. Okay. So simple position, 68.97. We've got a negative 0.37 delta, almost 40 cents. So what happens if the stock drops 2 points in the next 10 days? It goes down to 66.97 in the next week or so. Let's go 10 days out in time. That's a good round number. Okay, so we'd expect a gain with implied volatility of 0.2429 of 55 cents. Not quite tracking the delta exactly at negative 0.37. We'd expect that to be up to 74 cents. But that's because maybe the lower delta, or, I'm sorry, the lower implied volatility, or just because the expectations of the farther out option in the theoretical pricing model. But a 2-point drop theoretically might see a 55-cent gain on our call option, put the value at around 250. Now what if I go up to 0.285 with the same decline 10 days from now on 227? See, now it's almost double. Not quite. We're up to 98 cents. That's significant, isn't it? With a subtle move of only 2 or 3 points, 2 points down roughly from where it is, the delta change, the implied volatility change of only 0.035, roughly, or 0.03, almost doubled the profit from 55 to 98. Now, we're talking about small profits, I understand, but the purchase price was $1.95. Here you're almost at a 50% profit on this put position. Why am I going through this exercise? I'm going through this exercise, Scott, because I want to show you this is how I would analyze if I'm buying a call or buying a put. I'm going to go, once I've identified it, into the profit and loss chart, and I'm going to run the what-if scenarios. And I'm going to evaluate what, based on my expectations of the stock falling 2 points, 3 points, 4 points, or percentage if I'm doing it that way. When I go to that option research page, I'm also going to look at this implied volatility range, because I want to know if I'm running those theoretical prices, what do I expect the option to be trading at if it falls a certain number? I want to test it to both the high, if it goes back to that for some kind of adverse market condition or bad news, and also the low. So in addition to evaluating it on the current implied volatility at my prices, I'm also going to take the very lowest implied volatility. Let's see what happened there at 0.2259. Probably only going to be about 30 cents, maybe less. Yep, 38 cents. So that's a significant difference. Even though the stock declined in the first 10 days, the few points I expected, yours sounds much more like a longer term position, Scott. But as implied volatility is fluctuating, this is what you're going to see. If you bought the option at the money, you bought in at the highest time premium. And as the stock moves away, as it goes down and it's in the money, or it goes up and it's out of the money, you're pulling away from that peak of the time value curve, the at the money bell curve, and that's going to show up in your extrinsic value decay as well. So these are things that you want to look at. These are things you want to test on the option research tool. Test all 3 levels of implied volatility. And, of course, run those different scenarios. And your follow-up question, of course, to this it was a follow-up, I'll admit that. Also, you had 2 follow-ups, I'm sorry. This was just the illustration that what boxes and numbers should I enter to find stocks that I think will move down? Well, I don't have long put here, but as you've heard me say before, and we have some of those presentations on the criteria for bullish and bearish positions, what I look for in a long put is the same thing that Ernie has in here basically for his Bollinger Band screen. I'm looking for stocks in a downtrend where we're near the lower range of the Bollinger Band, the lower Bollinger Band, and not too great of a broker recommendation. I may also look for something that has a negative MACD crossover, where the MACD has crossed the signal line for at least the last 2 or 3 days or so. That is in a current downtrend, just to emphasize that more. Is mine coming up? No, it's not. I thought it would. But I see ones that are in there, Rheingold Resources and some others. I was looking to see if Newmont Mining was going to come up here. That's a married put I'm in that has just been terrible the past 10 days. I'm still at a profit on this position, but nowhere near where I was, and I still have a chance to do an income method to help the position. It's just not there yet. What do I mean by these 2 criteria? These are just criteria we use So what I'm looking at here, this is what Ernie would call a Bollinger Band breakout. The stock is broken down and closed, broke down below the lower Bollinger Band once it closed again and is continuing to move down. And there's that 2 to 3 days MACD negative signal, seeing sort of a negative movement in the security at this time. Now we can cherry pick and say, oh, you would have been so much better if you bought a put up at the high. Well, a lot of times when it starts hitting this upper Bollinger Band, it continues to move up until some news comes out. And this clearly looks like an earnings event, by the way, that sudden gap down. It could not be, but that looks like an earnings event. And last but not least, based on what your expectations are for the stock, regardless, you might want to consider looking for positions that have a percent implied volatility range in the lower values, say 60%, less than 60%, maybe less than 50%. Now, stocks that have been recently declining, we're not going, oh, Devon is still there as well. And that's just something I like to use. But again, I have the column here for implied volatility. I'd probably also add the column in for the percent implied volatility range and the actual implied volatility range. And why? Well, we're going to look at it on the research tool. But the reason why is sometimes you have to take it with a grain of salt. This one's fine. So the 4% implied volatility range, it's near the bottom. So I'm not expecting, this is over the life of the option. Since the option was released on the market, the peaks of the volatility, the implied volatility for the option. So it's only at 0.4336, and the absolute low it's been since it was released on the market is 0.4253. I like that because I'm not too concerned that it's going to suddenly drop to 0.38, 0.36, 0.25 in those ranges. But the height is 0.6447. That's a pretty good range. If this IV moves up to 0.5, goes up to 50%, that's going to help my position. Why do I say you need to take this with a grain of salt? Because sometimes you might see a position that has a percent implied volatility range of, say, 85%. And you say, oh, Mike said not to do that. I don't really want that. But if the total implied volatility range of that option is only 0.334 to 0.339, very small, and it's currently at 0.338, well, take that with a grain of salt. You're not seeing much movement in the implied volatility. There's likely not an event coming up. You are at 85%, but it's a very tight range that is so negligible, or is negligible to begin with, that you just don't worry about it in those cases. So that's the implied volatility discussion on your AZN position. The risks maybe of buying at the money, the risks of implied volatility flux, and even a small implied volatility flux of 0.03. We saw that how your expectation, it might actually cut the value of your expected profit in half. And if it flows back down to the low, it might be much less than you thought as well. Time decay, the extrinsic value movement, if you bought right at the money, is also going to hinder that position as well. Now, on this note here, on this discussion here, I want to continue on real quick with one more thought, and then we'll get to the other part of your question. Remember, use the long option finder. Long option finder tool could be accessed in the signature tools under the long put or the long call, and just put in your stock symbol AZN, and I say, okay, expected stock price, what do we do? 66.97, 2 points down from where it is, not much of a movement. Let's say we're going to put $1,500 into options, and we said 10 days from now on the 27th. Now, what that tool did in that brief instant is it went out and looked at every option, grabbed the current price, and ran the Black-Scholes pricing model to calculate how many contracts you could buy with your investment amount, what the expected price of this option would be on the target date, and which options would give you the best theoretical return. And now I could recalculate with a different implied volatility. What if I expected to go back down to 0.42 as we saw before? Instead of 33% returns, still the same option, but we're seeing 30% returns, 26% returns, lower ranges than we expected with a movement in implied volatility. The reason why I'm showing this tool is because it's very powerful, Scott, but also in addition to that, you originally bought the put on AZN because you expected a price change. You expected a downward move in the stock to some target. This might have helped you based on where you expected the stock to fall, and in the target date, you expected the stock to reach that lower price. with or without factoring in the implied volatility, which I'm going to encourage you to do, especially if you're doing things around earnings, what your expected up value would be and which option would give you the best return if the stock did hit your target on your target date or close to it.